what do you think risk management is before I hop into the whole gist or the whole detail of what risk management is? Can anyone at all share their own thoughts, ideas, and perspective about risk management? Anybody at all? Can anyone share their thoughts, ideas, or perspective about risk management? Anyone at all? Just share it in the chat box. Chat box, just drop it. I'll get to see it and I'll make comments on it. And also, please let's respond to the polls. Thank you very much. Okay, we've got someone typing and trying to drop their perspective on what risk management is. Okay, we've got a lot of people typing and trying to drop what they think risk management is. Okay, still waiting on that. Let's see what we have from Nkichi. Okay, risk management. It's just a compound word. Okay, risk and management. What do you think risk management is? So I just says is the ability to keep your account out of being blown. Risk management, minimizing errors towards failure. I so much love those two perspectives. And to be very candid, risk management is all about what you guys have made mention of. Risk management is all about what you guys have made mention of, which is keeping your account from blowing, minimizing your error. Kelechi says the level of mental tolerance you're willing to endure. Brilliant, brilliant. That's amazing. Now, before I hop into what risk management is, in this session, what you would learn, what we would go through in this session, we'll go through a general overview of what risk management is. We'll give you an understanding of risk management using protective orders, such as stop loss, take profit, and position sizing. These things will protect you and help you manage your risks the right way. Calculating risk, and lastly, conclusion. All of this would give you an edge in managing your risk and playing the long-term game in the financial markets. Now let's dive into the general overview. Risk management is the most important yet least talked about topic in trading. Okay, it is the most important yet least talked about topic in trading. It's very, very important, but not everybody talks about it. Everybody is more concerned about the strategy they use to trade. Everybody is more concerned about being profitable. Yes, those things are important, but if you have a good strategy and you don't have a good risk management approach, you might not be profitable. If you are profitable, that means you have a good risk management approach. In this lesson, we'll talk about only the most important things about trading when it comes to risk management. And risk management approach is often drawn to personal reference, okay? Personal preference and good journal keeping. Now, I can tell you everything about risk management, but it still comes down to you as a trader. It still comes down to what you like and how well you keep record track of everything you do in the financial markets. How much should you risk per trade? Should you risk more than a certain level in certain scenarios? And what is the highest R, lower strike rate versus lower R, higher strike rate, and more? We'll talk about these things in this session. So I want everybody to please do take notes and keep an open mind. Keep an open mind towards it, because you will have your own perspective about risk management. But this is just a general perspective based on what majority of traders think in the financial markets. Now, the truth is, no matter how fancy the lines are on your chart, no matter how fancy the lines are on your chart, there's no point in it if you get your account blown, okay? If you get wiped out trading, okay? Managing your risk is the best thing to do. That's the right way to go, and staying in the game for long. I made mention of staying in the game long term, okay? Long term. You want to accumulate profits and scale your trading account and be able to maintain consistent growth in your trading account for a long period of time. Now, what really is risk management? Okay, understanding risk management. This is a fundamental trading approach that comprises of the actions you as an individual take or the tools you put in place to protect your trading account or your trades from ending in losses or a significant loss. Okay, now it's comfortable or it's common for trades to end in a loss, and it is very, very, very common for trades to end in significant losses that you'd have to deposit again. Now, what risk management does is to protect you from significant losses, keeping your losses minimal and helping you increase your profit potential. So, in other words, risk management, like I said, it's a compound word. Risk and management. Risk is basically damage. Okay, risk is basically damage. Management, how you curb that damage. Okay, so in a layman term, risk management is curbing the damages that come to you. In this scenario, we'll put it to the financial markets, which is to reduce the damage that comes to your trading account, to reduce the losses, the hits you take from the financial markets. I know you'll be wondering, why am I making mention of this? This is to let you understand that 3 out of every 10 trades you place have a tendency of ending in a loss. 3 out of every 10 trades you place have a tendency of ending in a loss. Because this way, using risk management helps you curb having 10 losses to 3 losses and gaining from 7 trades. Okay? The more you risk means the higher chance of your returns. Yes, in the financial market, if you risk a lot, it means you are willing to make a lot. But there's also a greater chance of you incurring a significant loss if the trade does not go as planned. Okay, now for you to make money, you have to put money on the table. That's the best explanation to this. And you must be willing to lose a certain amount of money to make a certain amount of money. The more you are willing to lose, the more you are willing to make. In the financial markets, if you have $100 account and you're willing to risk all that $100 account at once, you should be willing to make more than that $100 at once also. But remember, if you are risking all you have, there's a chance that you can lose all you have. So this is where risk management comes in play, where you need to be able to devise a method or an approach that will help you curb losing all your $100 at a single run or in a single trade, and still give you the opportunity or the chance to make more money from the financial market. You might be wondering, how is this possible, or is this even possible at all? Yes, it's very possible. Imagine, this is just a hypothetical example, okay? If you're risking 3% of your trading account, you should be able to make 6% of your trading account on one single trade. If you're risking 3% on one single trade, you should be able to make 2 times that 3%, which is 6% on that single trade. That is a good risk management approach. If you're risking 1, you should be able to make 2. If you're risking 2, you should be able to make 4. If you're risking 4, you should be able to make 8. Now, imagine you're risking all your 100. Okay? Imagine you're risking all your 100 in one trade. Is it easy to make 200 on that same trade? The answer is very rhetorical. Yes and no. Okay? If the market's going your direction, you would gladly or you would easily make that 200. But if it goes against you, you easily lose your 100. But let's bring it down to the scenario of you risking 3% and making 6%. You are risking 1. It's very easy to lose 1, and it's very easy, or it is more easier to make 2. This is why you need to have a good risk management plan, curb risk management, or curb the risk in your trades, and manage it the right way. Okay? So risk management is not the same as money management. I get to hear this a lot. I get to hear this a lot. Risk management is not the same as money management, and I'll make emphasis on it. Risk management, you are covering the dangers, okay, towards your trading account. Money management is how you just navigate your equity. Okay, money management is like, okay, if I make $100 every week, I'll be withdrawing $50 every week. That's when you are managing the total amount of equity that you have, putting it into something else. You might be putting it into stocks or cryptocurrency. That's how money is being managed in the financial market. But risk management, you are trying to reduce the amount you will be losing. Okay, and the major thing is traders fail to understand the difference between these two, and I hope I just made clarity towards what these two means. I'll be teaching you how to manage risk the right way. I'll be teaching you how to reduce your 50 pip stop loss. I'll be teaching you how to reduce it to 30 pips. I'll be teaching you how to reduce that initial $100 you want to lose. I'll teach you how to reduce it to $10. I'll teach you how to reduce that one standard lot you want to use. I'll teach you how to reduce it to one mini lot, and you still make the same amount of money with risk in check, without blowing your account in one run. Before I proceed, do we understand what we've been talking about? Yes or no? Do we understand what we've been discussing? Yes or no? Also, do you have any question at all? Okay, I would like to take questions, not even at the end, but in between the session, okay, in between everything we're discussing. If you've got any question at all, drop it in the question section. I would attend to it. Okay, I'd like to get a lot of response to know everybody's following. Okay, I'd like to get a lot of response to know everybody's following. If I made mention of something and you don't understand, please do let me know. I just sent out a poll. Please, let's respond to it. Okay, I sent out a poll. Let's all respond to it. Okay, we've got 2 yeses. Brilliant. Now, using protective orders or protective measures, if I would say. Now, the first thing is stop loss. These are things you need to put in place. These are things you need to put in place before you even decide to place that single trade you are looking at. Okay, these are things you need to have in check before you place that trade you want to place. Now, the first thing is stop loss. The definition for a stop loss is basically an order to close a position at a certain price point or percentage to limit your losses. That is what the stop loss is. Stop loss is you telling us at Eagle Global Markets, I bought AA at 2. I want it to go to 5. If AA goes to 1, close my trade for me. That is what stop loss means. Okay, that is basically what stop loss means. Another example is you go to a supermarket, your budget for a certain item is 10. Okay, but you see the item at 15, you can't afford it. You sway away from that type of product and you go for a cheaper one. Stop loss basically means we have a financial instrument AA. You bought financial instrument AA at 2. You want financial instrument AA to go to 5. But financial instrument AA is not going to 5. It is now at 1. All you are saying is, Eagle Global Markets, close my trade on financial instrument AA at 1 in a loss. That way, it limits your losses from big to small. Now, I always make mention of this every single time, is to use a stop loss. I always use a stop loss, and I implore you to do the same. Now, the reason I implore you to always use a stop loss is because of stop loss protects you as a trader from a lot of things. It doesn't even protect your balance only. It protects you from having a bad emotional state. or putting yourself in a bad emotional state. It protects you from losing your mind. It protects you from saying trading is a scam. It protects you from a lot of negative factors in the financial markets. Okay, but the major thing is it protects your capital when you are on the wrong side of the trade. That is the major thing a stop loss does. Okay, it protects you from losing your mind in the sense that when you lose a trade, you get angry at everybody and at almost everything. It protects you from that. The losses will be small. You will not be able to take out that anger or whatever emotional state you're in on people around you. You'll be able to curb it because you believe if you lose a dollar is equivalent to 450 naira. You believe 450 naira is something you could dash your neighbor's kid or your kid, or you could use it to recharge your phone. You believe it's something you could use on things that are not necessary. You let that slide. And this is just the major advantage of a stop loss. Now, before you place any trade in the financial markets, I advise you have a certain number of stop loss. Now, I've said this a lot, and I know most people might say, okay, that's not the right way to do it, but this is how to do it. This is the right way to do it. The right way is have this number of guaranteed stop amount in your mind. Always have a guaranteed stop in your mind. Now, if your guaranteed stop is 30 pips, a standard 30 pips, okay? That is the stop you have in your mind that you want to use, not even the stop the trades provide. Now, if you trade very aggressively, having a guaranteed stop of 30 pips is good. If you trade very conservatively, every single setup you have on your table should provide you with lesser than 20 pips. Then you can adjust it to 30 pips. Having a guaranteed stop is important. So you now have something in mind that helps you in scaling, in reducing risk. Now let's move on to risk appetite. Risk appetite is basically how much you want to lose. Okay, risk appetite is the amount of risk you are willing to tolerate on your trading account while trading. The amount of risk is basically how much you're willing to lose. Now, you should have this guaranteed in your mind. The amount of risk you are willing to take on your trading account. If I have a 100,000 naira trading account, I am comfortable with taking 2% risk on that my trading account. I'm comfortable with that. On taking 2% risk on that my trading account. Why? Because I understand if I risk 2%, I'll be looking to making 4% and above. 2% won't hurt me. That's one thing I will keep in mind. 2% won't hurt me. And knowing that if I risk 2%, I'll be willing to make 4%, I am comfortable with it. So to manage your risk effectively in the financial market, you should be willing to risk between 1% to 5% of your capital to give you your grid a floating space. Now, there's this idea I use whenever I trade. I tell myself I want to risk 3%. Okay? It is in between 1 to 5. Initially, my plan is to risk 2, but that 3% gives my grid a floating space. Okay, we all have this mindset of price will soon reverse, price will soon go to our direction. That 1% added is to give us that confluence that in case price doesn't go in that direction I want, okay, it is time for me to close my trade if I'm not using a stop loss. Okay, or it is time for me to reduce my stop loss to where I know it will hit soon and move out of the trade. That is what your risk appetite it just helps you understand this is how much you'll be risking, this is how much you're comfortable with losing. Now, on to position sizing. A position size is basically the number of units or an instrument you are willing to buy at any given time. We have 3 types of lot sizes. Now, let's start from the dollar platform. Okay, we have the dollar platform, we have standard lot, mini lot, and micro lot. Okay, the standard lot is 1, the mini lot is 0.1, the micro is 0.01. Now, the standard, if you place a trade on the standard, you are making $1 per trade. Okay, per point, sorry, $1 per point. On the mini, you are making 1 cent per point. On the micro, you are making 1 penny per point. Now, someone has $100 account and he feels he wants to make $1 per point. He uses a standard lot. This standard lot literally opens the person to a lot of risk because he's purchasing a huge unit of that financial instrument, but doesn't have the capital that covers for it. So in that sense, the person is over leveraging. The person is trying to bite more than what he or she can chew. The two key pieces, okay, the two key pieces of terminologies a trader needs to know in establishing your right position size is stop loss and risk appetite. Is stop loss and risk appetite, and I'll show you basically what it is. Those two factors, stop loss and your risk appetites, is what helps you in calculating risk. Okay, calculating how much of risks you'll be taking on your trading account. In calculating your risk, you need to know, in calculating your risk, you need to know what your risk appetite is. You need to know what your risk appetite is. Now, we'll be using 100,000 naira in our example, okay? The standard 100,000 naira. That's what we'll be using in our example. And using 100,000 naira gives us a edge, okay? Gives us an edge. The capital is big, okay? Capital is big. We'll be using 100,000 naira. Now, if we have 100,000 naira, your trading balance, like I said, in calculating risk, you need to know what your risk appetite is. How much are you willing to risk on a trade? So let's say, for instance, we have a 100,000 naira account and we are willing to risk 2%. Okay, I'd like everybody to write 2% down on a piece of paper that they use to calculate possibly their stop loss or their take profit or how much they'll be putting in the trade. Okay, so if we have an initial 1,000 naira, we want to risk 2%. What is your initial stop loss for trades? Now, this is basically on you as a trader. This is determined by you as a trader. Okay? This is determined by you as a trader. What type of trader are you? First, are you conservative or are you aggressive? From there, you can decide what type of stop loss you'll be using. Now, for aggressive traders, they like to use tight stop losses because they are going in immediately. They want to catch the most move, so they don't want the market to flip against them or against them immediately. So they use a very tight stop loss. For conservative traders, they use a bit broad stop loss because they are trying to give price a breathing space. Now, aggressive traders try to use 15 pips to 20 pips minimum, okay, or maximum 15 to 20 pips. Conservative traders try to use 30 pips, okay, or 30 points minimum. So let's just use 30 points as our initial stop loss. Now, your initial position size, this is where you get to determine it. Now, it is advisable to risk between 1% to 5% of your trading account on every single trade you place. But in this scenario, we'll be risking 2%. Now, if your equity is 1,000 or 100,000 naira and you want to risk 2% of it, basically what it means is you are risking 2,000 naira on every single trade. You are willing to lose 2,000 naira on every single trade, which you are comfortable with. Okay. Now, once you've understood that you are losing 2,000 naira per trade, your initial stop loss is going to be 30 points. Okay, 30 points. Now, for you to get your position size, it is going to be how much you are losing per trade and the initial stop loss for trade, which is going to be 2,000 divided by 30, which is going to give you 66.66, which is initially approximated to 67. Now, this is for those that are trading on a Naira account. Basically, on every trade you will be placing, you are going to be using 67 Naira per position. Now, the minimum on a Naira platform is 50. That means you are going to be using 67 Naira per point when you place your trade. Now, this basically gives you an edge. Number one, you've known that on that trade, you'll be losing 2,000 Naira. The initial stop loss is 30. So you're using 67 points per Naira per point on every single trade. Now, for those that are trading the dollar platform, it's still the same approach. You still get the same result, but your own result is not going to be in whole numbers. It's going to be in decimal. Because remember, we said the standard lot is 1, the mini lot is 0.1, and the micro lot is 0.01. With this approach, you can easily curb your risk, and also the losses will be small. There will be nothing like huge losses occurring on your trading account, because remember, it is standard. This is how much you'll be losing on every single trade, 2,000 naira. And also, this helps you scale your accounts better, in the sense that as your account grows, you don't just use this calculation constant. Okay, this calculation is not constant. As your account grows, so let's say for instance now you use this approach, you placed 5 trades. Okay, you placed 5 trades, and you made money from 3 of those trades, and you lost 2 of those trades. Okay, so let's say initially from those 3 trades you made some 5,000 naira. From those 2 trades you lost 25,000 naira. You've made a profit of 50,000 naira. You now have 150k. Remember, you are still risking 2%. You are still using 30 points. 2% of 150k will now be 3,000 naira. That means on a single trade you'll be risking 3,000 naira, and you'll be open to make more than 3,000 naira, still maintaining the initial stop loss of 30 pips. The risk from this approach is very, very small, and the losses and huge losses are unlikely to be incurred. Okay, huge losses will never be incurred if you use this approach when you place your trades. If you use this approach to manage risk whenever you're placing your trade, you notice this is different from every single thing I've been talking about when it comes to risk management all this while. This is how you should be managing your risk. This is how you should position your lot sizing in the financial market. This is how your initial stop loss should be. Have that initial stop loss in mind. Don't just say this is where the area is. You can mark the area out on the charts, but don't just put it in your mind. Mark it on the charts and see it. So whenever price gets to that level, you close your trade, or you just put the stop loss there. Now, to conclude on what we've been discussing about risk management, you see, truth be told, you might have learned forex from somewhere else. You might have seen people discuss forex. You might have heard people talk about forex, and you see they are very, very much concerned with the profit-making aspect, the strategy aspect. But truth be told, the importance of risk management can never be overemphasized. Okay, because of risk management is the backbone to any good trading strategy, and that is what separates you as a trader from gamblers. Okay, this is what separates you as a trader from gamblers. Risk management is helping, or is simply focused on you surviving in the financial market. Now, I like to use the word survive in the financial markets, basically because for you to continue to earn a certain stream of income, okay, consistently earn money from the financial markets, you need to survive in the financial markets. Okay, you need to make the best decisions For you to survive in real-time scenario, it's by you making the best decisions. And the best decision you are making is based on risk management. It's not to get eaten, not to lose money in the financial market. And that's the best. It's focused on you surviving. If you survive today in the financial markets by making profits, tomorrow you follow that same approach, you survive again, you make money. You survive. That's how compounding takes place. That's how you grow your trading account. That's how you scale your trading account. You scaling your trading account is not even by increasing your lot size, it's not by applying that new strategy. Everything works in the financial markets, whether you are using technical analysis, retail trader method, or smart money trading method. Like, everything works in the financial market. The major thing that is of high importance is risk management. It helps you be alive in the financial markets. Now, one of the best risk management practice is to keep a trading journal, a record of your trades, your trading journal. See, if you can understand why you lost money on a single trade, you won't repeat that same mistake again. 85% of losses you incur in the financial market is not because of the market. It is because of a mistake you made. Okay, it is because of a mistake you made. The financial market is never against you. You are the one not doing the right thing in the financial market. So if you are able to understand that mistake you made that initially made you lose money on that trade, you will not make such mistakes again. You understand why that mistake occurred, and whenever you see such, you will gladly know how to avoid it. You would so much know how to avoid it easily that it doesn't affect your trading account anymore. Lastly, you need to exercise caution when you trade. Okay. Now, I used to say something which is basically your $100 cannot move the financial markets. That's why you're trading based on leverage. Okay, added money, borrowed money. See, when you're trading with leverage, okay, every single time we trade with leverage, okay, you need to master your skill on a demo account. Now, I have this misconception about demo accounts. Because you are profitable on demo trading doesn't mean you'll be profitable in a live trading scenario. Why? The truth is, your emotions are not attached in a demo environment, in virtual money. It's not your money, so you can trade it anyhow. But when it comes to your money, emotions will become attached. You would bow to your emotions and you will end up losing money. So my best advice is never to try to demo trade for 6 months. No, you would get so addicted to it when you come to a live trading scenario and you see that your money is on the line. You would not want to lose your money, whereas you want to lose a demo money. Okay, don't demo trade for too long, or even if at all, don't demo trade at all. Just go to a live account. Now I know it might sound quite absurd, but just go to a live account straight with money you know you want to lose. Okay, with money you know you want to lose, because if you understand you are going to lose this money, that is what will ginger you. Let me use that word, ginger you, give you the edge to not want to lose the money, because you want to abide by every single piece of your rules in trading and the financial markets. That is just the major thing when it comes to risk management. And we've come to the end of today's session. I'm open to taking questions now. So I saw someone drop the question in the question section. Please kindly join the link. And profitability is the easiest thing to attain in the financial markets. Follow your rules, stick by it, do the right things, understand how you capitalize on these things, and you get to earn the most of it. Till I catch you in the next session, good luck and good trading.